Opendoor stock is up about 700% over the past month, going from about 50 cents all the way to $4.30 as of today, in which the stock is up nearly 100% in one day today. But why is the stock doing so well over the past few months? The main reason for Opendoor's huge surge in stock price is because it has captured the attention of retail investors over the past week, in which it has been circulating all over Reddit and people have been buying up this company, in which the rally was sparked by a bullish July 14th post on X from EMJ Capital's Eric Jackson, which laid out a good turnaround case for the company, in which he set a very bold long-term price target of $82 per share. Keep in mind, the stock was at about $1 per share when he made this, or even less, in which he thinks the stock could potentially have an 80x return on your investment. So this is a huge, bold assumption, but he anticipates Opendoor to actually post their first positive EBITDA in August. So that would help the company out a lot, but do I think that it should be $82 per share? I don't know. Then that's why we're going to be analyzing the financial health of Opendoor and using my intrinsic value calculator at the end of the video. But let's first talk about what Opendoor Technologies does. Opendoor Technologies is a digital platform that streamlines the process of buying and selling homes. It allows homeowners to quickly sell their property by requesting an instant cash offer online, so they can quickly sell their homes with quick cash offers. And also, buyers can explore and purchase homes directly through Opendoor's website or app with a real estate agent. So it's basically like Realtor.com and Zillow in the sense of buyers, but sellers can actually get quick cash deals right away if they wanted to sell their home quickly. So that's the only real difference between Opendoor and these other Realtor.com and Zillow, in which the Opendoor actually buys some of these homes up too. So that actually looks good for Opendoor, and I like that. The first two metrics that I like to look at for my 7-step stock analysis has to do with the valuation of Opendoor Technologies. And I like to look at both the trailing P ratio and forward P ratio. I want the trailing P ratio to be positive, which means the price divided by the earnings is greater than 0, meaning the company is profitable. But as we can see here, the trailing P ratio is nothing, meaning the company is losing money each year, which I don't like. And also looking at the forward P ratio, I want this less than 30, but also greater than 0. But as we can see here, the forward P ratio is also non-existent because analysts don't expect this company to become profitable in the next year. So this company is an unprofitable company, so it's going to be hard to value the company and also just determine the financial health. But nonetheless, these are 2x's, and so far the company is unprofitable. Taking a look at the revenue growth rate, I want to see a greater than 5% revenue growth rate from Opendoor. And as we can see, we saw huge growth in 2021 and 2022, probably because that's when the housing market was doing really good. But now the housing market has cooled down from those COVID times and actually started to level out. But as we can see, they are starting to grow over time since 2024. So if they can continue this slight growth over time, it doesn't look too bad. But we can basically remove this in 2022 because that was a pretty unprecedented time, and that was just when the market was doing really good for real estate. So that's kind of hard to tell with Opendoor Technologies. But since 2020, it has grown almost double, because in 2021 they had about $2 billion in revenue, and right now they have about $5 billion. So technically their revenue growth is about 20% each year. But the problem with this is that it's very inconsistent because of the cyclicality of the industry of real estate. But they are still growing at a pretty good rate, so that's good. Now with the net income of Opendoor, and I want to see the net income increasing at greater than 5% over time. And this is the big problem I have with Opendoor, and I personally don't invest in companies that don't make money because it's very hard to value a company that isn't making money. And right here we can see that they're losing every year. They're losing money every single year with this company. So I really don't like that about the company. But nonetheless, the person that had the price target of $82 did say that they're going to start to become profitable in the next quarter of EBITDA. So that could show us that the net income in the future could become profitable. So right now, technically the net income looks very bad, but if they can become profitable, it looks pretty decent. Now taking a look at the shares outstanding of Opendoor, I want to see the shares outstanding decreasing over time, because if the shares outstanding decrease over time, that means us investors investors will own a greater percentage of the company. But as we can see here, they're increasing shares basically every quarter. And when I mean basically, they're increasing it every quarter by about 5% each quarter. So this does not look good for Opendoor, because the reason for this is year over year, they're increasing at 5%, meaning that us investors are actually losing 5% of our ownership over time. So if that compounds over time, you're going to keep losing 5% each year, and then over time, you're going to own less and less of the company. So they're going to be diluting us shareholders right here, as we can see. So that is an X for me, and I don't like companies selling their shares. But I will say the good thing is that the company is unprofitable. And the good thing about selling these shares is they're actually making money on these shares. Especially, I would like to see them selling shares over the next few days or over the past few days, because of the huge rise in stock price. Then the business will actually have more money over time and could actually turn the business around with this huge stock price jump. So that's the good thing about selling shares when you're unprofitable. At least the company is making money. So that's the only good thing. But nonetheless, the shares outstanding are going up. So that's not good. Now, taking a look at the balance sheet of Opendoor, I want to see the total debt to equity ratio less than 50%, in which that means they would have more than double the amount of equity than their debt. And as we can see here, their total debt to equity ratio is insanely high, 391% total debt to equity ratio. This means they have 3.9 times more debt than their equity. And taking a look at the total cash compared to their total debt, they have $559 million in cash. When compared to the debt, they have $2.5 billion, in which the market cap of Opendoor is greater than the amount of debt that they have, which is a very big red flag for this company. And this automatically tells me to not invest in this company, basically, because I'm a type of investor, I need to wait at least a little bit to have some confirmation they're turning this business around. And right now, the metrics and the financial health of this company does not look good at all. So me personally, I am staying away from this. But I'm going to keep going ahead and take a look at the future estimates from analysts, and then take a look at my intrinsic value calculator. Taking a look at analyst expectations for the next 5 years, I want to see a greater than 5% earnings per share growth rate. And as we can see here, they're expected to grow at about a 22.7% earnings per share growth rate. So they're expected to grow very fast each year over time. So this actually looks pretty good for the company, and maybe they can turn profitable in the future. That would be very good for the company, but this is a good check mark. Now, looking at my intrinsic value calculator, I'm going to do assumptions of the future for most of these metrics to determine the fair value price of the company and to see if we should be buying the stock today. So the first thing I have to do is future annual revenue growth rate. And the company's been growing at about a 20% each year growth rate, and analysts expect about the same thing. So I think 20% could be fair for this company, in which this would have $31 billion of revenue in the next 10 years. Now for the future profit margin. This is where it gets very hard, and I basically have to guess, because none of these real estate companies, such as, say, Realtor.com or Zillow, they don't make any money, so it's hard to have a comparison, and Opendoor obviously doesn't make money. So I'm going to be fairly conservative here, but also bullish at the same time, since they're not making any money. But I think a 5% future profit margin could be fair. Now for the future P ratio. I think a fair future P ratio for Opendoor could be about a 25 PE ratio. So the future P ratio of 25, we get a future market cap of almost $40 billion. Now for the shares outstanding. They were increasing their shares by about 5% each year. So I think they can continue to do that, which is not good for us, but I think that it's definitely possible for them to keep doing these increases in shares and diluting us shareholders. So that's the problem with this company. But nonetheless, I get a future share price of $33 per share and a total annualized return of almost 70% each year. So with that being said, this value of the company looks pretty good. But I would like to say this is assuming the company does become profitable and maintains the profitability. And this also doesn't take into account the amount of debt this company has. So me personally, I'm still going to be staying away from this company, because this is assuming pretty bullish case for this company just because of the future profit margin. But with this, I do get a good return on the company. But nonetheless, I'm staying away from this company because it's not making any money and it doesn't really show any signs of starting to make money in the future. So me personally, I'm staying away, but do your own research on this company to see if this is really worth a buy at $4 per share. So thank you guys for watching this on Opendoor stock. Please comment down below what stocks you want me to analyze. Each weekend, I'm going to be making videos on the stocks you comment down below. In the most liked comment, I will be making a video on one of these stocks. So thank you guys for watching. Please subscribe and see you.